Let's try to price a call option through the binomial model by using H0 and B0. As an options trader at the CBOE, you are tasked with pricing a European call option on Quake Games Incorporated. The strike price is $75 and there are 6 months until expiration. Quake Games common stock doesn't pay dividends and is currently trading at $57. Based on your models, the future stock price is predicted to be either $92 or $40 at the end of the next 6-month period. The effective annual risk-free rate is 4%. Estimate the price of the call. How much of a share of the stock do you need to buy and how much do you need to borrow at the risk-free rate to replicate the call through a synthetic portfolio? Check whether your synthetic portfolio replicating the call will have the same payoffs as those of the call at expiration. So again, we will create our diagrams for the stock price and call price. So S0 should be equal to $57, the current price of the underlying asset, and the stock price can be either $92 or $40. The price can either increase or decrease. And we will do the same for the call option. Remember, we are after the price of the call option, current price of the call option. Strike price is 75 at time 1, C1 plus. Actually, in that case, the call option is in the money and the call will be exercised. So you will buy the stock at $75 strike price and can sell it at $92 in the market. So your payoff will be 92 minus 75, which should be equal to $17. And if the stock price is $40, the option is out of the money and the option will not be exercised. You won't be buying the stock at 75 when in fact it actually trades at $40 in the market. So the option will not be exercised in that case. The call option is out of the money because the price of the underlying asset is less than the exercise price, so the call have zero value and will not be exercised in that case at time 1, of course. So next, convert the EAR, effective annual rate, to representative periodic rate. So 1 plus R 0.04 to the power of 1 should be equal to 1 plus R semi-annual to the power of the Y, because we are after the 6-month periodic rate and there are 2 6-month periods in a given year. That's why we have to the power of 2 here. So solving for our semi-annual will yield our semi-annual equal to 1.04 to the power of 1 over 2 minus 1, 0.0198. Then plugging the numbers into the following equations will yield the following. Remember, H0 will be the difference in the payoffs of the call option divided by the changes in the price of the underlying asset. So remember, these values were shared on the previous slide. So 17 minus 0 divided by 92 minus 40, 17 divided by 52, H0 should be equal to 0.327. And B0, the amount you need to borrow for the call option, C1 minus H0, S1 minus divided by 1 plus R. So just plug in the numbers. H0 you already have calculated. These all other variables were already given, so the amount you need to borrow should be equal to $12,826. Now we can calculate the value of the replicating portfolio, which should be equal to the price of the call. So C0 equal to V0, which is also equal to H0 multiplied by S0 plus B0. So the 0.327 multiplied by H0 was 57 plus B0. B0 was minus 12.826. This should be equal to $5.813. So we create a synthetic call by buying 0.327 shares of the stock and borrow $12.826. Now I will check whether the synthetic portfolio replicating the call will have the same payoffs as those of the call at expiration. If S1 is equal to $92, remember C1 is equal to $17 as the call with a strike price of $75 will be exercised. In that case, we want the value of the replicating portfolio should also be equal to $17 if it really replicates the call as is claimed. So at time 1, V1 should be equal to H0 multiplied by S1 plus B1, not B0, because we are looking the value of the replicating portfolio at time 1. Remember, H0 was 0.327 multiplied by S1. S1 plus in that case, because we are looking for this case in which the stock price has increased, so multiplied by $92. Uh, Plus B1. Actually, B1 is B0 multiplied by 1 plus R because we are looking at the future value of the amount borrowed. So remember, this was the value of B0 multiplied by 1 plus R, the future value of the amount borrowed. This should be equal to $17, which is the same as the call payoff. So the portfolio really replicates the call. For the lower boundary case, in which S1 or S1 minus more precise is equal to $40, remember the call payoff should be equal to zero as the call with a strike price of $75 will not be exercised. In that case, we want the value of the replicating portfolio should also be equal to zero. Again, if it really replicates the call as is claimed. So again, V1 should be equal to H0 multiplied by S1 plus B1 as we did before. So H0 was this value, S1 minus was, in that case, it was $40. So B1 should be equal to B0 multiplied by 1 plus R. Again, we get 0. So the synthetic portfolio really replicates the call payoff for the case in which the stock price declines to $40. Remember, the call payoff was $0 in that case because the call with a strike price of $75 will not be exercised. For the second case, actually, V1 has a value of 0.40452, which is very close to zero. The difference stems from the rounding. If you were to use exact values of H0 and B0 or B1 more precisely, because remember, you need to calculate the future value of this B0 to have to get the value of V1 at time 1, as well as of the risk-free rate, you would get V1 equal to 0 in that case.